Good evening, good afternoon, ladies and gentlemen, I should say. Happy Friday, March 4th to all of you. It's great to see you here for the Power Options RadioActive Trading Open Discussion and Open Forum presentation. I hope everyone had a good week so far and is looking forward to a good weekend as we get another week closer to March expiration and another cycle of options coming out soon. And of course, we might have seen some new options come out soon for the weekly options, of course, yesterday for the new series cycle coming up on March 11th, next Friday. All right, well, let me just introduce myself briefly and then we'll go ahead and get started. My name is Mike Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie and Greg and the Power Options staff for the past 8 years. I handle a lot of the free coaching sessions and education on the site. The coaching sessions are important, of course. Any one of you who is on a free trial, current trial to Power Options, or is a subscriber to Power Options, you can register for one of those free coaching sessions at any time. They are completely free. There's no limit to how many sessions you can have, And the sessions consist of essentially a 40 to 50 minute one-on-one phone conversation with myself or possibly with Ernie. We'll answer any questions that you have about the site, about the various strategies or options techniques, and of course use the Power Options tools to illustrate the education and the format of your questions. Now, I've also co-authored 2 books on options investing with Ernie Zerener, one on naked puts and one on protective option strategies using different forms of married puts and collars. And I am versed in all strategies on the site. We do support over 23 different option strategies on Power Options. However, there are certain strategies I will not trade in my personal account. Strategies such as iron butterflies, short straddles, short strangles, and naked calls don't match my personal risk-reward profile, so I typically don't use, actually I should say I've never traded one of those in my personal account. However, I'm familiar with the fundamentals and the setup and the risks of those positions, so if you have any questions on those strategies, please feel free to ask them at any time. All right, well, the processes and procedures for this afternoon's presentation will usually be online until about 5:30 Eastern Time this afternoon, maybe a little bit after that, depending on the volume of questions. Use the question pod on the GoToMeeting platform to pose a question. Please feel free to ask as many questions as you want. Depending on the volume of questions, we may not have time to answer all the questions, but we'll usually stay on an extra maybe 10, 15, 20 minutes to make sure that we get through all the questions that have been asked. And of course, if there's a question that requires a little bit more description, what I'll usually do is typically email you after the presentation with a more in-depth answer if I feel I couldn't answer your question in full during the presentation. Questions can really be about anything you want. The tools on Power Options, the RadioActive Trading techniques, the Power Options Applied newsletter service, or just general options strategy and education questions, or general market questions as well. We can't give direct advice. I can't give direct advice on your positions, for example, or if you ask me, well, what are you trading now? What are you not trading now? What do you think is going to happen in the next 2 or 3 weeks? Well, I can't give any kind of financial advice along those lines, but I can answer any basic questions about market, options strategy, education, general thoughts, ideas for managing positions, and so forth. All right, the basic ground rules, we just asked that, hey, don't be shy. Ask any questions that you want. This presentation is designed for you to have a free, open forum to have your questions answered. So don't be shy. Ask any questions that come to mind. Be patient. There might be 1 or 2 questions ahead of yours, and we're going to try to get through them all. But if I haven't gotten to your question yet, just be patient. I never ignore a question as it comes in. And we also want to encourage you to feel free to help us help others. If one of the registrants has posed a question and I'm supplying an answer based on my market experience and what other customers have told me for that kind of situation, if your market experience, you have something different to offer, something else that you've noticed during a similar situation, use the question pod to send that over to me and I'll share it with the rest of the group as well. Most important, we're down to another week, going ahead to another weekend here at the near beginning of spring, getting closer to the beginning of spring, I should say, and warmer weather across the country. So let's relax, have some fun, and get some good education. Now, for today's discussion, we're going to start off, as we always start off with these weekly discussions, we're going to run a basic naked put search just to see if there are any new weekly options that have been listed as of yesterday. Every Thursday, the new cycle of weekly options are released. Last week and the week before, we noticed there was a total of 50 stocks, ETFs, and indexes that offered weekly options. So we're going to take a look and see if there are any new ones that are available today for next cycle. And then, of course, we'll handle any of your questions. I don't have any special presentations slotted for today, but if there are no immediate questions that come in after we go through that weekly options search, then I'll think of something. Presenter's choice. I'll think of something that I had a discussion with earlier this week, maybe during one of the coaching sessions or one of the customer discussions, and we'll present that until we see some questions come in. All right. Well, with that being stated, let's navigate over to the PowerOptions suite of tools. I'll go ahead and prompt everyone. If you have some questions, go ahead and send them over. And what we're going to do right now is, as we start off every open discussion presentation at the end of the week, Friday at 4:30, we're going to go into the naked put screen, or the naked put menu, and we're going to go directly into the search tool. And what we're going to do is run a basic search for just the one strike out of the money options, the naked put options across the market, on any securities that have options expiring about 8 days from now, 8 or 9 days from now, next Friday. Okay, so that'll show us the total number of weekly options that are available for next week, the securities offering weekly options. So let's go into the search, and as many of you know, a couple weeks ago we did save the weekly options screen, and I believe, nope, we don't have that up right now. But I'm going to walk through the process of how we would set up just a basic search for this kind of criteria. And we just have some basic features in mind. We just want to see those options that expire next week, and we don't want to see a lot of duplicates, meaning if I just searched for all securities that had options expiring next week, well, I might get 10 different strikes on, let's say, Apple, which does offer weekly options, or Amazon, for example. We just want to see the one strike out of the money so we don't have multiple stock duplicates. So to create that search, all I'm going to do is scroll down to the bottom of the parameter field below the listed trades, and this is where we can set our criteria. There's about 20 to 25 different option criteria you can use in any of the 23 strategies, and about 30 to 35 different stock criteria you can screen for as well, just to identify the positions that you want to see. But we're not going to use a lot of limitations. All I'm going to do right now is click Clear These Settings down here at the bottom. That's going to empty everything out of our parameter field for the naked put search. And I'm going to change my option expiration time frame to March. I want to force the days to expiration to be between 2 and 9 days at a time. Well, the reason I'm selecting 2 is we still have technically in the database 1 day left for our current weekly options, the options that are expiring today. We don't put that as 0, that's currently a 1 today. The weekly options haven't been settled yet. The ones that expire today, I'm sorry, they haven't been settled yet. They typically settle, I've been told, I think at around 7 or 8 p.m. Eastern Time, or maybe it was 7 or 8 p.m. Central Time this evening. So by searching for March, but 2 to 9 days out in time, we're only going to see those securities and those options that expire Friday of next week. But I also don't want duplicates, so I'm going to force the range out of the money. I can screen by range in the money or out of the money, by number of strikes or by percentage. And I'm just going to use the number of strikes field for show out of the money to be between 1 to 1. So I'm just going to restrict it to the one strike out of the money, naked puts for any securities that have options expiring between 2 and 9 days from now. Now once I've made those changes, let's just go ahead and click Submit. And last week we had 50 total stocks, ETFs, and indexes that offered weekly options. Hey, great. Now we have 60. See down here at the bottom is our total listing. We have 60 total results. NVIDIA. I don't remember seeing that one. I'm going off the top of my head now. Molly Corp. That's a new one. Patriot Coal. I've never seen that one in the weekly list before. They offer weekly options. U.S. Steel, I'm pretty sure, was there. AIG was there because we were tracking some positions a week or so ago. EWZ, I do remember seeing. Potash, Priceline, GM, those were all there. All right, so we've got NVIDIA and PCX and Molly Corp. All right, so we've got 10 new, minimum of 10 new. Let's check page 2. I'm pretty sure Suncor Energy is new. F5 Networks, I believe that one is new as well. FIV, SU, don't remember seeing those. El Paso Corp. I do not remember seeing that one next week. So that's 1, 2, 3, 4, 5, 6 out of the possible 10 new positions that we've seen. BP was there. GE was there. AXP. Not entirely sure if AXP was there. So let me write that one down too. Okay. But Ford, JP Morgan, those are all there. And most of these ETFs look familiar, of course. IWM. FCX we saw last week. Let's go to page 3, see what we have listed there as well. GLD was there, Apple, NASDAQ, Caterpillar we saw last week, IBM, Intel. Visa, I think, might be new. We saw Verizon last week, but I don't think we saw Visa, so I think that's another new one. And Mankind, that's a new one too. MNKD, down at the bottom there. And Visa, 2, 3, 4, 5, 6, 7, 8, 9. So I've got about 9 new stocks I'm recognizing just off the top of my head. Let's scroll down, though. Let's make a quick change. And what I'm going to do is we're incorporating all of the indexes, the ETFs, and the standard stocks that offer weekly options. I'm going to scroll down to the bottom of the screen here. And I can choose to screen specifically against a recommended list section or remove stock lists. So I'm going to go ahead and remove stock lists for right now. And I'm going to remove the indexes, ETFs, and holders. Let's go ahead and click Submit. So now we'll just see the stocks that offer weekly options. And of course, last week we ran the search as well, and I believe we had 30, almost positive, it might have been 31, but I believe it was 30 total results, stocks that had weekly options. Now we're up to 40. So I think only new stocks have been added. I don't know if any of the ETFs or ETNs have. All right, we knew LVS was there, so we saw some of those new ones come in. MCP again, NVIDIA, PCX, Patriot Coal. These are some of the new weekly options that are offered. All right. Well, I had mentioned that a couple weeks ago we had saved a search that was essentially based on this weekly screen we just did for the naked put menu. Well, let's just verify what we had last week. Let's say that we had actually run, what would happen if we had ran that same search, the weekly options search, on February 25th, last Friday at close of business? How many stocks would have matched our criteria? We have 40 here, and there were a total of 60 results when we first ran the search. So we have 40 stocks here, and that means we'd have 20 total indexes and ETFs today. Well, let's go into the backtest mode for a brief moment. So I'm still in the naked put menu, but I'm going to go into backtest now. And in the backtest features, we can do a historical search on a given date, or we can search by specific symbol on a given date. Well, I want to go into the Smart History Excel. What I want to do is run a search, simulate running a search from February 25th. So my search date, I'll select February. Now I'll get an available days feature, and I'm going to select the 25th. That was last Friday. It's going to give us the numbers at close of business on February 25th. And from our saved searches, I'm going to look for weekly stocks. That's the search that we saved a couple weeks ago, actually on February 18th, that was looking for the same criteria we just searched for. So let's go ahead and click Submit. And remember, when we just ran the search, we had 40 stocks that matched our search criteria. And today, we would have had 31. Oh, okay, so there's a difference now. It looks like if we ran the search on February 25th, we would have had 31 total stocks that matched our search listing. Okay, so that meant that we had, well, how many ETFs would we have had? Well, let's just check. We're going to change a brief setting. We're still in the historical, and I'm going to select No Lists now, and select to include, just to filter against the same weekly option criteria, but just against, well, something, I'm sorry, I'm missing something. There it is, indexes, ETFs, and holders. I apologize. So let me go ahead and do that, and we'll submit this search. So last week we had 31 securities that matched our stock search, and we would have had a total of 19. Yep, we're showing 15 of the 19 total results in the for indexes and ETFs that had weekly options. So we did have a total of 50, 31 stocks, 19 indexes and ETFs last week. And this week we have a total of 60 securities. But it looks like there were only 9 stocks, so there was an additional index or ETF that was listed for our current weekly options. So 1 new ETF or index was released, and 9 new stocks, which I'm pretty sure we found with NVIDIA, PCX, Molycorp there, PCX was Patriot Coal, F5 Network, Suncor Energy, El Paso, American Express, Mankind, and Visa. Those are the new 9 stocks that offer weekly options, and there is an ETF in here, a brand new ETF, this week that wasn't available last week. So the weekly options are growing. We're now up to 60 total securities that offer the weekly options. Okay, so just want to always review that, and probably try and write a blog this weekend about that and post it, and we'll do a comparison of which stocks and securities had weekly options last week on February 25th compared to the new ones that offer weekly options today. And we're at a total of 60 securities for weekly options. All right, let's go back to the main home menu. Do you have any questions about the weekly options or anything we just ran through on the search or the historical search? Go ahead and send those in. Or if you have other questions. I haven't had any questions yet, so if you have any questions about the Power Options tools, basic options trading, option strategies, general market questions as well, use that question pod to send those over to me. Remember, don't be shy. This presentation is designed for you to have an open forum to have your specific questions answered, so go ahead and send those over to me. While I'm waiting, I guess I'll show a basic feature of Power Options that might not be obvious to some of you who just started on the trial, for example, or some of you who have been maybe subscribers to Power Options for a while but never specifically took a view of some of the more some of the other tools, where you can search and analyze. Now, the way, of course, the Power Options tools are set up is that we do support over 23 different strategies. And to select a strategy, of course, you just have to have it available in your tab feature. Now, we do only allow about 7 to 8 different strategies to be selected. If you don't see a strategy that you normally use, for example, on this listing, I have covered calls, naked puts, for example, bull put credit, married put, bear call credit, iron condor, and collar. But if you happen to trade long calls and long puts, you don't see those available here in these listings. Simply click on the Other Strategies tab, which is always locked in place, and this will allow you to customize your tab menu feature. So let's go ahead and remove bear call credit for now, and also remove iron condor. I can always add them back in if later on you have a question on iron condors or bear call credits. And let's just add long call and long put into our menu there. Okay, and I'll go ahead and click Save. And now we see that the long call and the long put have been added to our menu. Now, if I want to look for positions in a given strategy, let's just click on long call, for example. We can go directly into the search tool. We just saw that with the naked put menu. I can customize my criteria and search for only those positions in a strategy that match my option requirements and my stock requirements. You know, if I want a certain minimum option ask price, if I want a certain liquidity, open interest, or option volume, for example, certain range in or out of the money, or if I only wanted to see long calls or long puts on stocks that had a certain average stock volume, or trading in an uptrend or trading in a downtrend, for example, we'd use the search. The sample searches allow us to look for positions in that given strategy one stock at a time. So if I just wanted to see some bull put credit spread combinations, sample searches are theme searches you can use as a stepping stone. In long calls, if I just wanted to see all the available options, I could just select on the option chain. But if I was in the bull put credit menu, what I'd want to do instead is use the search by symbol. So if I just want to see the available bull puts on Apple or Amazon, I just use the search by symbol tool to evaluate the different risk-reward ratios one stock at a time. But what if you wanted to see, you're interested in, let's say, trading, let's just take SPY, the S&P 500 ETF. And let's say we had a bullish expectation on SPY, but we wanted to maybe see some potential covered call positions. Maybe we also want to see some standard collar positions on SPY, maybe even a bull put credit spread. Maybe we even wanted to look at perhaps long calls or calendar spreads. how could we look at all of those or some suggested ideas in those strategies all at once? Well, to do that, we'll use the search by strategy search summary page, excuse me. And to access that, we simply have to type our symbol into the top field here, and we can access the chain or go to the detailed quotes page, the detailed stock research page. But I'm going to go into search summary, the links next to the main input box. So I'll click on search summary. And this will take us to the strategy search summary page where we can evaluate the various strategies all on the same page, some suggested or some listed strategies all on the same page for one stock at a time. So I have selected here, we have covered call, so I have a few opportunities for covered call for March expiration. We have some calendar spread opportunities listed here as well, calendar call spreads, both horizontal and diagonal if I'm not mistaken. Oh, no, these are all diagonal. Bull put credit spreads, bull call debit spreads, so you can compare sort of just the risk versus reward on the same page here. We also have some long calls there at the bottom. So you can select a variety of different strategies, or we can just clear all the strategies and I can choose to just select the bullish strategies, and I'll select all those criteria for me. Covered call again, bull call debit, married put, collar, bull put credit, long call, and so forth. Or if I just selected bearish, now we just have bear call credit spread, covered put, bear put debit, naked call, and so forth. Or if I just want to see the neutral, we could see the straddles, iron condor, iron butterfly, and we could look at the neutral positions as well. So the strategy search summary tool will help you get sort of a bird's eye view of multiple strategies on the same stock in a given expiration cycle. Instead of going into each individual strategy and comparing a bull put on SPY using the search by symbol to say a long call and then a covered call. You can kind of get an idea looking at the search summary page. All right, well, let's get into the questions. Oops, I apologize. Just made a small mistake there. Mark wants to know, what are your general thoughts about using the weekly options? I don't really know how to answer that, Mark. To me, there's no difference. I know the differences, but there's no extra inherent risk trading the weekly options as opposed to trading the standard monthly options. Because they're a shorter time frame, my basic thoughts are I'd only do income strategies with the weekly options. I doubt I would ever use long speculative positions. For example, assuming that weekly options didn't exist, if you asked me, well, when you're doing a covered call, how far do you go out in time? Or any income strategy, covered call, bull put credit, naked put, for example, debit spreads, the sort of directional trades where you're generating income up front, I typically don't go more than 45 days out in time. The reason why is I'm giving less time for the stock to move against me, and I'm compounding or I'm potentially increasing my annualized return. Now, that being said, if I'm doing long positions, if I'm looking to maybe do calendar spreads, for example, using a long option and a calendar spread, or if I'm just buying calls, buying puts, doing long straddles or long strangles, when I'm buying options, I'm going to be buying further out in time. One, to give the stock more time to move in my desired direction. Number two, I pay less per day as I buy further out in time. The option that's 6 months out in time will never be 6 times the cost of the near-term option. So that being said, considering weekly options, the only strategies I'd really consider are those that are incomes. I'd never probably buy a call, buy a put, do a long straddle or a long strangle using the weekly options because it's just too short of a time frame for the stock to really move in your desired direction, unless you're expecting a really big pop or you have some inside information that I'm not privy to on some of those stocks or ETFs, for example. Now, one concern with the weekly they have the same risk-reward requirements as regular options, of course, of regular calls and puts, same requirements and obligations. The reason why I run this search every week is to kind of illustrate the point and also show that they are expanding, but at the same time, if I focused my whole trading portfolio off of trading, let's say, covered calls or naked puts or credit spreads just on stocks that had weekly options, or even stocks, indexes, and ETFs that have weekly options, I have a very limited universe to choose from. There's only 60 total securities that offer weekly options. So my thoughts are they're a very good instrument to use. You want to make sure that you're very aware of your risks and obligations in any strategy before trading any option, or especially just trading the weekly options themselves. You have to be ready to accept smaller premiums. Not smaller returns, mind you, and definitely not lower annualized returns per se. But when you do a weekly option, you're shortening the time frame. The premium that's available every 7 days is going to be much smaller than what I would normally expect to see when I'm searching 30 days out in time. For example, if my normal mode of operation, I should say, is to trade covered calls or to roll naked puts on a regular basis, I'm usually entering new positions the Monday or Tuesday following an expiration cycle when my capital has been freed, whether I've been assigned or liquidated my positions or so forth. So I'm looking to enter new positions the Monday or Tuesday following an expiration. And with doing a covered call or naked put, I might specifically be screening for positions that offer, let's say, a 2.5% return if assigned in regards to the covered call or higher, or maybe a 2.5% naked yield when screening for a naked put. However, if I'm trading weekly options, I just had my options expire today or I liquidated them today, and I'm going to open new positions next week, I can't screen for covered calls in the weekly options that offer a 2.5–3% return or higher, or a naked yield of 2.5% or higher. I have to take a little step back and realize that, well, I'm not going to be able to get that same premium week by week by week. Well, if it's there, these search tools are going to find them. But I have to cut my expectation down. My static return for a weekly option, whether covered call or naked put, might only be 1%, 1.2%. Now, if I do that over the 4-week course of an expiration cycle, I might have a 4.5% return if I was able to get assigned all 4 weeks and make my maximum return. Whereas if I just sold it 30 days out to begin with, the standard expiration cycle, it might have only been 3.8% or 4% static return. So you have to look at the broader picture when doing the weekly options. You can't expect to get the same return you would on a standard expiration doing a weekly option. You have to keep in mind that you're going for more of an annualized return and a more active adjusting and rolling with your option positions. But they are very useful securities, very useful derivatives to use. The weekly options are, but your universe is limited, and you have to accept a smaller thing, a little smaller premium when you're originally just looking for those. Okay, Mark has another question. How do you manage the naked put if the stock goes against you down past the strike price? Well, there's a couple things hidden in the basic answer to that question. Let me go back, and let's go into that naked put screen again, and let's go into backtest, and I'm just going to jot down maybe a position or two. Let me see if I can think of anything off the top of my head. I'm going to go back into the historical suite of tools here. Let's go back to February 25th, and I'll use a weekly option as an example. But this will apply to the same techniques I might use, if we can find a good example, Mark, that I would use on any naked put position. So I'll go to weekly stocks. And of course, some of you know I'm going to have to tease, I'm going to have to put in a teaser after I go through the description here as well. And I'll explain that in a moment also. Let's see here. I'm looking for something specific. I'm going to go ahead and try POT for the time being. Last week, we could have done the March 58.3 put for 68 cents. 58.3 put for 68 cents. Now, before I do anything, but yeah, 68 cents, I apologize. And that was on POT, okay? The reason why I'm choosing this is I believe POT is below 58 right now, but I'm not positive. So let me go up here, and let me just take a look at the quotes very quickly. I just want to look at the static quotes page. Ah, I was wrong. Got to find something that's dropped. Let's do something a little bit different. Let's take something, and let me go to home. Let's just fake an example instead of trying to look for something historical. Let's see, what was down today? Well, I got a lot of indexes that were down. Those are down. Anything down pretty big? Ooh, that's XII. I don't want to use that. There's more indexes. How about that? APA. Or I could use IBM, but I think I'm going to use Apache. APA. Let me think. Give me one. I apologize. Just give me 1 second here. Yeah, we'll use APA for now. It's at 122.62. So we're going to fake a position. I'm going to go into my portfolio, and I'm going to go into the profit and loss portfolios here. I wish I had something a little bit lower. Oh, okay. After all this discussion, I apologize. I'm going to use AIG. Should have selected this beginning. Here's a long put. Here's a short put by itself, but it's linked to the long put. But we're going to clear this up. This was treating the calendar spread that we started a couple weeks ago. We were just managing it. We actually turned it to a horizontal. But I'm going to trick the system a little bit. Here we have a March 38 put that we sold for $37.39. I'm sorry. Let me rephrase that. Here's a March 38 put that we sold for 57 cents on February 25th. Stock's now below our strike price at $37.39. It does expire today. It technically expired today, but we should still be able to see some adjustment opportunities. Stock's now trading below our put strike price, and our required ask price to buy to close this weekly option is 74 cents. Now this is showing it in the context of a calendar spread. What I'm going to do is actually just delete the long put leg. So I'm going to go to my position actions menu. I'm going to delete this long put. And that'll just leave us with the naked put that's now in the money. Nope. I apologize. I just wanted to delete the leg. I would not want to delete the position. So let me try that again here. Delete leg. There we go. All right. Okay, so now, here we are, Mark. If I was tracking a position in the portfolio, I've got my March 38 put. AIG is trading at $37.39, so about 61 cents in the money. We did show a last ask price of 74 cents to buy to close the position. So as I scroll over here, just basic view, our original expected gain was $57 for one contract, and right now we have a loss of about 0.4%, $17 or 0.4% on the position. Now, when I'm trading a naked put, just as when I'm trading any strategy, I have to go into the position with some things in my mind, really some things I want to have written down. First, I'm never going to sell a naked put on a stock I would not want to own. If I was not comfortable owning AIG at $38, and technically, what I'm actually saying is if I'm not comfortable owning AIG at $38 minus 57 cents, so at $37.43, for example, the different, the break-even price there, then I never would have sold this put to begin with. You don't want to be attracted to selling naked puts just because the premium looks good. Never sell a put on a stock you would not want to own. And I also tell that to my credit spread customers. My customers that do bull put credit spreads, I always remind them, don't do a bull put credit spread. Don't sell a bull put credit spread on a stock that you would not want to own. Because you have to remember what the obligations are. Sure, you can always roll the positions. You can plan on not buying the stock. Sometimes that might be out of your control. If I'm in a bull put credit spread, like we were, let's say, with AIG, if I had the 38 put here and I had bought the 35 put, and the stock's at $37.39, well, the 35 put's still going to expire, but I have to remember that my obligation when I sold that put was that I'm required to buy shares of stock at $38. That's my obligation. If someone assigns me early, my broker is going to buy shares of stock for me at that price. So never sell a put unless you're comfortable owning the stock. Number two, always have an exit strategy written out in place. When I typically sell a put for standard expiration, 30 days out, less than 45 days out in time, the standard month-by-month expiration, I usually look to buy to close or to adjust my short put, my naked put, if the stock reaches within 1 or 1.5% of my short put strike price. In this case, if the stock, originally I probably would have opened this position by selling a 38 put when AIG was maybe at 39 or maybe at $39.50 per share. Well, if the stock dropped down in price and was trading at maybe $38.40 or it dropped down to, let's say, $38.20, that might be a trigger for me to consider buying the close at 38 put and rolling it to the 37, the next strike down, or maybe liquidating the position so I don't take too large of a loss. So before we talk about how we would adjust it, we want to talk about the things you want to do ahead of time. Have the exit strategy in play. Have sort of a stop order or stop limit placed based on where you'd want to adjust the position or trigger of when you'd look to adjust the position, and never sell a put against a stock you would not want to own. Now, when you're tracking a naked put in the PowerOptions portfolio, as we are here, and the stock has dropped, what we can always do is go to the position analysis screen. So from here, go to position actions, and then I'm going to go to position analysis. And for all of the strategies that are supported on PowerOptions, the analysis page will give you a breakdown of the position. Okay, well, our time value has declined. We are on 1 day to expiration. Now I scroll down a little bit further here. It just gives me the profit and loss chart, my original expectations. And we see here we have what we just saw on the other screen. I have my current liquidation values, my original expected return, current liquidation value, and then my future expiration value, which today is pretty much close to the same, of course, because we're on expiration. But as I scroll further down, we see some potential rollout opportunities. Now, this offers a lot, and part of the well, it's actually not showing the weekly options. But if we decided not, your first choice is just liquidate. Okay, you could buy to close the put and just close it. We could roll to a different strike price if you wanted to continue it in that fashion. But another thing you could do is that we may be forced to buy shares of stock at 38, and we could turn the position now into potentially a covered call trade to help recover any loss. So just taking a look at the first example, if we were forced to buy the stock, we'd of course buy the stock at, let's say, $38 per share. We keep the premium, the 57 cents, and then we could sell, let's say, a new April 37 call, so now slightly in the money, for $1.82. This is the full expiration, 43 days to expiration. This would have an adjusted cost basis, break even of $35.61, still offering about a 3.9% if assigned between when we open the position and April expiration, or about a 33% annualized return. Of course, since it's the just slightly in the money position now that the stock has fallen, it's about a 53.2% probability that stock will remain above 37 at expiration. So let the stock be put to us, sell maybe the April 37 call, and we'll turn the naked put into a covered call position. And we can simulate what this looks like, of course, by going to the More Information button from the Rollout Opportunity and selecting Simulate Trade. And this will give us that side-by-side comparison. Okay, so right now our current return is our current loss is 0.5%. We expected a max percent return during the weekly option of 1.5%. If now we're forced to buy shares of stock at AIG, it's shown at $37.56. That's including we're going to be forced to buy shares of stock at 38, but it's subtracting the original premium of the put there, and then we'd sell to open at 182, the new call. So now we see that our total maximum return here, we go from what we had on the left, the original position, where we're currently at a loss, that we could potentially make that 3.5, 3.6% return if the stock stays above 37 in the next 43 days. So that's one of the ways you do. You can buy to close the put. You could roll down the put, of course, and I think it's because it's a weekly trigger. It's a weekly option right now. But a lot of times when you're tracking a naked put, it'll show you the returns and calculations if you just rolled the put to the lower strike price, or if you allowed the stock to be put to you and turned it into a covered call. Because you want to compare those side by side, which one might be better for you. This profit and loss chart that we're looking at here, by buying the stock and rolling to the, having the stock put to us and selling the April 37 call, would have a similar risk-reward profile, of course, to if we bought to close our current call, the 38 call, and then sold to open the new Let's start over. This profit and loss chart for the covered call would be a similar risk-reward profile and possibly would have a similar return to the new value if we bought to close our 38 put right now and sold to open the April 37. You'd want to compare those side by side based on your expectations. In this case, since I didn't make an adjustment on my weekly option and it's in the money, if this was a real trade, on Monday I'd see that I would own 100 shares of AIG at $38 minus my initial premium that I received. So I'd have a cost basis of 100 shares at, let's say, $37.43. So those are the adjustments when the stock goes down. But what I never personally allow myself to do, or allow to happen, Mark, if I can avoid it, is I'll usually have a stop order or an alert in the portfolio placed to be notified if the stock reaches within 1 or 1.5% of my short put strike price. And that to me is a trigger to reevaluate the position, why the stock has declined, and if I want to roll the put at that point or just close it and get out of the way. Now, all that being said, you can at any time get further information on not only how we recommend adjusting the position, but also how we use the PowerOptions tools to track and trade naked puts ourselves with the Naked Put book. That's one of the books that I wrote with Ernie Zeriner, co-authored with Ernie Zeriner. You can click on the link right here on the Naked Put menu or go into the Power Store. The Naked Put book is 250 pages long. It's about 225 pages long, I believe. Let me check real quick. I've got it right here by my desk. I did have it right here by my desk. So, yes, it's about 220 pages long. It's $13.95 plus about $3 for shipping. So about $17. You get the full thoughts of Ernie and myself, how we approach sort of the naked put investment, how we use the PowerOptions tools to do it, and our thoughts on adjusting the position if the stock goes against you, or rolling the position if the stock's still expiring or moving up, for example. And, of course, how to use the PowerOptions tools to do that as well. So in addition to what we just reviewed, as you're tracking the position in the portfolio, it will show you some of the suggested adjustments if the naked put's going against you in the position analysis screen with the new calculated returns and new probabilities, and the full description of how we would approach this, how Ernie or myself approach this particular strategy. Can be yours for only $17. And of course, if you purchase the Naked Put book, I'll make sure that Ernie and myself sign it for you. Okay. My personal, a lot of investors, Mark, will talk about, rolling if I have a covered call and the stock's moving up, it's gone above my short call strike price and I'm going to get assigned, maybe I'm expecting higher returns. A lot of investors will advocate, okay, we just want to roll the call. Buy to close your current call and sell to open the next strike. Okay, well that's great when the stock's going up, even with a naked put, because you just let it expire and then you look to sell a new put. But a lot of people will also advocate rolling a covered call down or rolling a naked put if the stock's to fall. So with the AIG example, we had the put at 38. Stock's now down to about 37, 39. Buy to close my 38 put before letting the stock get put to me, and then now maybe sell the next expiration or the next month expiration. I might look to sell the 37 put or the 36 put, trying to stay out of the money, generate new premium. Well, before you do that, you always have to evaluate your position as you're getting close to an expiration or you're about to make an adjustment. What I mean by evaluate is you want to go through the same steps you did originally when you opened the position. You want to take a look at the stock chart, company information, the news, and the profile. Keep in mind, this stock went against your expectation. You might have opened this position 7 days ago, or it might have opened it 30 days ago with the expectation that the stock was going to be trading at or above $38 in the AIG example, or at or above my put strike price in the naked put. It's gone against me. For whatever reason, the stock's not doing what I initially expected, so now I have to evaluate, again, what do I think is going to happen in the next 7 days, or what do I feel is likely to happen in the next 30 days? It doesn't help me to just buy to close a put that's now in the money, buy to close a short put that's now in the money, and sell to open a lower strike put if my expectation is the stock's still going to fall. Because then I'm just going to have to do it again next month, and then I'm going to have to do it again the month after that. At times you just have to admit that the position is wrong, that your original research and analysis was wrong on the position. It's going in an opposite trend, and rather than continue to roll to a new strike price where you could get yourself into more trouble, you may be better off just liquidating it, taking the loss, and then going into a new position that has a better pronounced trend. It's hard to swallow. I mean, it's hard to say that, and as investors, we try not to let our emotions get involved. Many of you know that, of course, we work closely with Kurt Frankenberg, and Ernie and myself advocate the radioactive trading technique, using a unique form of married put position, focusing on limiting risk first rather than generating income as a covered call or naked put. I traded covered calls and naked puts for about the first 2.5 years that I started trading options. I eventually moved to calendar spreads and standard collar positions, and I was really successful with calendar spreads for about an 8 to 10 month period. And then in the 2 or 3 month periods shortly after that success, I almost gave everything back I made with calendar spreads as the market started to move against me. The lie of leverage started to crush me, and I was giving back almost all of my returns I'd made in the previous 8 or 10 months. But you would be amazed And I don't think you would be amazed. You've probably heard this before, and you've probably felt this before. When I first started with Power Options, once I got really comfortable with all the strategies, I get calls from customers who, of course, were doing covered calls or even naked puts. And they'd ask me, well, my stop losses keep getting violated. I had a stop loss on this position at 8%, and it gapped down, let's say, 18% overnight due to poor earnings. So I suffered essentially a 17% loss because my stop loss got violated. How can I protect that position so this doesn't happen again? Say, oh, you just turn your covered call into a collar or just buy a put. Turn it into either a standard collar with a put the same expiration as your covered call, the call that you sold, or buy a put that's maybe a couple months out in time to protect the position long term. And I always got the same argument. Well, no, I don't want to pay insurance. I don't want to put any money into the position for an insurance policy. That's admitting that I might be wrong. Well, sometimes you have to admit that you were wrong. Otherwise, unfortunately, you keep managing a position and rolling a covered call or rolling a naked put down as the stock continues to fall. Now, I'm not saying that anytime in the near future I'm expecting, of course, anything along the lines of what happened in 2008, fortunately. I hope we never see anything like that again. But I was amazed at a lot of customers who continued holding their covered call positions and just kept rolling month by month by month during the crash of 2008 and didn't exit the position because they still had the thought that, oh no, I can keep rolling and make it back. Well, as the stock fell 25 to 30%, sure, they generated some premium as they were rolling the calls down over a consistent 6 or 8 month period as stocks continued to fall. So instead of having a 25 to 30% loss, they had a 20 to 22% loss. You just could have maybe, if you, of course, hindsight's 20/20, but if you consider buying a put at that point when things started to fall instead of just rolling down the call or just rolling down the put, or you just kind of looked at it and said, yeah, I'm wrong in my direction, let me liquidate the position and hopefully try to move to another strategy or to another direction, then your loss would have been maybe limited to only 5 or 6%. And then you wouldn't have to struggle to make 40% to get back to break even. Now, I don't want to lecture, I don't want to preach, but I just wanted to remind everyone that with these strategies, that's the important thing, is to realize that sometimes you just have to, anytime before doing an adjustment in any position, even if it's a bear call spread, even if it's a calendar spread, even if it's an iron condor, before doing an adjustment, don't roll for the sake of rolling. A lot of us have been trained that, okay, a covered call is going against me. What am I going to do? Oh, I'm just going to buy to close my call that I have now because it's a cheaper price, and I'm going to sell to open a lower strike call, and I still might get a profit if I get assigned. And you're right. If your expectation is the stock's going to stabilize or move back up, rolling that covered call, rolling that naked put could benefit you. But if you have any fear or any expectation the stock might continue to drop, you don't want to try to catch the falling knife, and you don't want to stand in the way of the freight train. Liquidate the position, take a small loss. If you want to trade that stock again, wait till it restabilizes, and then look to enter the position. I just wanted to point this out very quickly. I'm going to go back to the home menu, and I'm going to go into the Learning Center. A few weeks ago, I believe it was the beginning of February, maybe the end of January, I'm in the Learning Center, and I'm going to go to the Webinars menu. And in the archived webinars, if you go to the Options Strategies Archive category, if you click on that, there's some special presentations that we did, and one of them is called Waiting to Roll. Oh, it's 12/15. I'm sorry. It was older than I thought it was. December 15th, 2010, right around December expiration. And I don't like to sit, and I don't want it to come across I'm preachy. I'm usually educational, not preachy. But this particular webinar on Waiting to Roll was designed with specifically that in mind, showing some examples as we head into expiration, how it may or may not be a good idea just to roll for the sake of rolling, how you want to reevaluate the position, and there are going to be some opportunities that are shown for you in that position analysis screen on Power Options that will help you decide, is it a good idea to roll now? Do I want to wait to roll? Or might I just want to liquidate the position right now, buy to close the short call in the covered call example, or buy to close the short put, and then wait to see what the stock does next before making another adjustment. So you might want to check that out sometime. Now that I've prattled on about that for about 10 minutes, and you've probably gotten most of the information that's in that webinar anyway, let's do that. Okay, follow-up question from Mark. Mark, someone just asked me this question the other day, Mark. It was an email, and what the question is, some of you are familiar with the radioactive trading techniques, of course. It's where we use a married put. We're going to buy stock, and we specifically look to buy an in-the-money put that's far out in time to enter into a limited risk position but still have an unlimited upside profit potential. But we're not using leverage, of course. We're not buying calls and getting caught with a lie of leverage or over-investing in long call positions. We're forcing ourselves into an ideal-sized trade by buying stock and buying the put option for an insurance policy. Now, to reverse this, what could we do? Well, let me go into other strategies for a second. The standard thought is, if I want to reverse the concepts of a married put, why don't I just use a married call? Well, all of this is discussed in the blueprint in Kurt's book, which discusses his full methodology. If I wanted to reverse the concept, instead of buying stock and buying a put, if I'm bearish, can I just short stock and buy an in-the-money far-out-in-time call to mimic it? Well, you can, but we never advocate doing that. One of the reasons why is if you do that, you have to make sure, if you do decide to approach this strategy, the married call strategy, you have to make sure that you're not trading on stocks that pay a dividend. Because remember, when you're short stocks, you have to pay the dividend, which means instead of using income methods to lower your risk, you're in a stock where you have a forced income method where you're adding risk to your position, potentially every time you go through a 3-month cycle. Number 2, if you short stock in your account, what's going to end up happening? Well, you're going to have to pay a margin fee or a borrowing fee. Some different brokers have different names for it. So that means as long as you're short the position and it's still in your account, you're going to be paying a margin fee, which means, again, you're adding to your risk instead of subtracting from your risk on a regular basis. It might be small. It might be minimal, only 0.2, 0.5% of the total investment value of the short position. But that's 0.2 or 0.5% you might be adding each month. Okay? We don't advocate doing the married call. Profit and loss chart looks reversed, and it says, it's just the opposite. Instead of buying stock and buying a put in a married put, I'm shorting stock and buying a call in a married call. We don't advocate doing that. Kurt discusses, well, if I'm thinking about doing the married call, where I'd short stock and buy a in-the-money put option to minimize my loss on the upside if the stock started to take off, how about just reversing it and buying just an out-of-the-money long put? Instead of shorting the stock and buying an in-the-money call for protection, what about just buying the out-of-the-money put, which has the same synthetic profit and loss chart? Well, that kind of goes along with, you have to reverse your thoughts now, and you have to approach this from a different view, but you still have to follow the rules where you can't allow yourself to overtrade this position or over-leverage yourself. You can only do the same amount that you'd be willing to short with the married call. What I mean by that is that I would only still buy, if I could only do, let's say, short 200 shares and buy 2 long calls, if that was the risk I was comfortable taking, I can only buy 2 out-of-the-money long puts, and then I still have to take the money I would have been receiving for doing the married call aside in an interest-bearing account to do that. And that's always discussed in the blueprint. Why isn't the married put equal to a long call? That's discussed in the blueprint, of course. It's also discussed in Kurt's blogs. The married call is not equivalent to the long put. It's equivalent to the long put and having money aside in an interest-bearing account as well. But that's a suggestion. That's not the best way to approach it. Ernie and myself feel that the best way to apply the radioactive trading techniques in a bearish market is to do the same things you would normally do. Go into married put. I'm going to go into the search menu. And let me pull up the radioactive default screen to begin with. Okay, so we know with the radioactive default screen, we're looking to buy shares of stock, and at the same time we're buying puts that are at least 150 days out in time, no more than 20% in the money. We're not allowing our risk to be greater than 3.5 to 9%. Now, when we're doing it when we're bullish, Kurt advocates looking for stocks in an uptrend and that are at the IBD 50 and cancel list and some other basic criteria, such as average stock volume. But if you're bearish, let's take out the simple moving average. Instead of looking for stocks that are trading in an uptrend, let's just look for no simple moving average. And instead of the IBD 50 and cancel list, let's run a screen for married puts that match our criteria using the inverse ETFs. So what's going to happen if I'm bearish? If I'm bearish, the market's going to decline, but the inverse ETFs are going to move up in price. This way you don't have to think any differently. You're still using the same concepts. You're buying stock, you're buying a put, and you'd apply the same income methods, but these instruments are going to be moving up in price as the market's declining. So you don't have to change your thought pattern. You don't have to start thinking in reverse. So we'll just run a basic search here, applying the basic radioactive trading criteria to the inverse ETFs. And we've got the ultra short layman's, 3 times short, 3 times bearish. So we have a mixture of ultra shorts and short ETFs here that have married put possibilities. Well, I'm going to do a couple things very quickly. The first thing I'm going to do is we're just going to take out this basic view for the historical volatility and the average stock volume for now. And depending on your preference, if you have never researched the inverse ETFs before, Mark, or never looked at them, what I would suggest is you probably don't want to start off looking at things such as the ultra shorts, which are 2 times ETFs, 2 times short ETFs or 2 times inverse ETFs, or the 3 times ETFs. These have a lot of volatility and move very quickly. So I'm going to take out that average stock volume and the historical volatility. I'm still going to look for inverse ETFs, but at the same time now, I'm going to go ahead and remove leveraged ETFs. So I'm going to remove the 2 and 3 times ultra short and 3 times short ETFs and just look at the standard ETFs. And let's think about this for a minute. Let me run that search. Okay. Now, here's what I wanted to see. You're bearish on the market. You think the broad-based indexes such as the NASDAQ or the Cubes, the ETF which mirrors the NASDAQ, for example, or you think the S&P 500 index is going to drop, meaning the SPY ETF would fall as well. Well, we can do the shorts on that. So I could do a married put on SH, the short S&P 500. Here's the DOG, the short Dow 30. So if I'm bearish on the market over the next 3 months, I can do a married put on these short ETFs. Here's the one for the Cubes here, QQQ. It's PSQ, the Treasury Bond Index. Oil. If you're suddenly bearish on oil and you think oil is going to decline, you could do just a standard married put on the oil ETF, DNO. So we feel this is a better approach for investors who are used to the radioactive trading technique because you don't have to reverse your thoughts. You're still doing a married put on a bullish instrument, but it's a bullish instrument in a bearish market because it's an inverse ETF. So if the market's bearish and everything falls, my ETFs go up, hey, still look to do income method number 1. I can just consider selling a call. It's a lot easier to still follow the rules in the blueprint by keeping just the married put and applying the standard income methods on these instruments that are moving up as the market falls, instead of trying to look for married call opportunities and say, oh, well, income method number 1 is selling a call against my married put. So income method number 1 on a married call would be selling a put against the married call position as the stock starts to drop. So what range out of the money do see already it's just too in-depth. So you can keep the same concepts that you've already learned in the blueprint, but just apply them to the inverse ETFs if you feel we're in a bearish trend or getting into a bearish trend. All right. So that's just a basic description there of what Ernie and I advocate as far as using the radioactive trading techniques if you feel we're going into a bearish market or a bearish cycle. Now, the other thing to remember, the other thing to be careful of, Mark, is if you do decide to use any approach, really, in the bearish market, if you decided to do the married calls on broader-based stocks you're looking to short, or that out-of-the-money long put approach, or doing even the inverse ETFs, what we typically have to remember is that other than 2008 and some recent disasters we've seen, unfortunately, bear markets are shorter-lived. They're more rapid. So if I'm doing a married put, even with a put that's 150 days out in time here, or the married put on the bearish ETFs are at least 150 days out in time, I have to expect that I might only have a bearish cycle of a 1.5 to 2 month period. Hopefully, well, one way or the other, we can make money in different markets. But remember, typically, historically, what we see, not excluding 2008 and some of the other trends, but historically what we see is that the bear market comes quickly, lasts for a short time, steep decline. Great profits can be made in a bearish market if you're playing bearish positions, do not get me wrong. But it's a steep decline, but then it ends, and then the market starts to come back up gradually. The uptrends are very slow usually, historically, over time, looking at it at the broad range, and the bear markets occur much rapidly. So you might have to pay attention to these positions a little bit more and more actively manage them, because you don't want to get caught as we start hitting those quick spikes up and then start seeing a gradual increase in the market as a whole, because then your inverse ETFs will start to drop and start moving against you. And just a little tip. All right. Well, I don't seem to have any other questions right now. It is 5:29. I'm going to navigate over to our slideshow, but this doesn't necessarily mean I'm wrapping up the presentation. If you have any last-minute questions or any last-minute thoughts, go ahead and send those in, and I'll address those after I go through the next 3 slides here, just outlining some of the description of the power options. I just want to remind everyone, of course, that if you are on a 14-day free trial to Power Options, if you subscribe to Power Options, you will receive an additional 14 days free. So you'll have use of Power Options for 1 full month before you're billed for the service. Our subscription levels, the 20-minute delayed service, this gives you access to all the tools on the tool menu with 20-minute delayed quotes, all the searches, and the 23 different strategies. That's only $59.95 per month, or a discounted rate of $600 for the year. Our real-time service gives you access to all the tools on the tool menu with real-time quotes set at 20-minute delayed, is $79.90 per month, or $800 for the year. Now, historical data, the backtesting we saw, that feature we use with the naked put menu, that's not included in the 20-minute delayed or the real-time. The historical data is an additional cost. It's $99.95 on top of the standard subscriptions, and that'll give you a 3-month access. Works out to be $33 a month. However, if you subscribed and you're already on the real-time and you wanted access to the historical, it's cheaper by month, I should say, just to upgrade to the professional level of service. The professional level of service includes everything that's on the real-time service, but with unlimited access to the historical suite of tools. So you're really only paying about $20 extra per month instead of $33 if you got the 3-month access. However, if you're on the 20-minute delayed, it's cheaper per month, of course, to stay on the 20-minute delayed if you wanted to, and then just get the 3 months. It would mean only $33 a month extra, as opposed to $40 a month if you accessed it for 3 months, or stayed in the professional for 3 months. All right. Now, our upcoming webinar events, I haven't posted the new webinars yet. They'll be posted in about they'll be posted in about 15 minutes after today's presentation. You can register for those on Power Options or RadioActive Trading. I apologize for this one. Let me put a big green X through it since I don't have a red X, but I'll just put a green X for this. I thought I checked all my slides, but I didn't. Okay. Every Tuesday and Thursday at 12 noon Eastern Time, Kurt hosts his introduction to radioactive trading presentations. It's about an hour presentation from 12 noon to 1:15 p.m. Eastern Time on the radioactive trading techniques. Typically, every Wednesday at 12 noon, and this week, of course, we'll be doing the same thing. Every Wednesday at 12 noon, we'll host an introduction to Power Options presentation. It's just about an hour walkthrough, excuse me, of the Power Options tools, search functions, and so forth. And just about every Friday at 4:30 p.m. Eastern Time, we host this open discussion presentation. Now, I'll be traveling next week, so there will not be an open discussion presentation next Friday at 4:30 p.m. Eastern Time, but we will be back on March 18th at 4:30 p.m. Eastern Time. So those are just some of the upcoming free events we host every week, and I'll have those links posted for you on Power Options and Radioactive Trading probably the next 10 or 15 minutes, or I should say 10 or 15 minutes after we wrap up the explanation. Okay. Oh, sorry about that. Okay, Mark wanted to know that during a coaching sessions, can we hook up computers so I can see your screen? We typically don't do that unless a customer requests. On the fly, what we can always do is, if you schedule a coaching session, we can select, I can, on the fly, just select to have a go-to-meeting presentation, and then so we can go through it, and you'll be watching my screen as I do this, but you won't be I can allow you to take control of the screen as well, and you can show your screen. But we can do that. Typically we don't, but yeah, it's no problem. I can do a go-to-meeting on the fly, Mark, so you can see my screen. All right, Chuck asked a question. I can kind of go through this, Chuck, but it's running a little bit short on time here, but that's okay. Chuck wanted, and I apologize, it's not actually Chuck, I think it's Chuk, and I apologize if I ever mispronounce this. Wanted to know if there are no other questions, could you explain the profit and loss chart of a married put, a radioactive married put he's referring to, with what's called income method number 6, using, say, NTAP? Trouble calculating the profit and loss at different strike prices. I don't have NTAP plugged into my Power Options screen and tracking Kurt's position. I don't want to do something historical, but let me go into my portfolio and let's just see from scratch if we have any married puts that we've been tracking or paper trading that have moved up in price. Okay. Yeah. Let's see, that one's, I hate to say this, but that one's too good. That one's probably just right, but let me find something a little bit better. Maybe. Sorry, I'm just looking through all this position. I'll just I'll let everyone know that what I'm doing when I originally go into any of my portfolios, especially with the radioactive trading technique, the married put positions, what I'm focusing on is the gain, percentage gain and loss column, and I'm focusing on the first listing in the gain loss column, which is for the stock itself. Now this one here, Home Depot, looks pretty good. It's not quite at that 5% listing where I'd normally look to apply an income method, but it's close. It's about 4.5%. And here's one at I'm trying not to do the ones that are showing too much of a gain. Nordstrom at 4.1%, but it's still not near my put strike price. Wouldn't be a great idea to show an income method number 6 on that. Linear Technology is coming up to expiration soon, and it's at 34.50. That's probably a good one as well. It's 9.5% up. Medtronic, been in this position a while, and that's above the put strike. Okay, well, let's take a look at the Linear Technology position now. I want to use the Home Depot one. August 39 put, stock was bought at 35.62, gained $160 on the stock, and the puts declined about $125. Okay, so I'm sorry I can't use the NTAP example, Chuck, but let's take a look at the profit and loss chart for Home Depot and set up an income method number 6, doing a nested trade, income method number 6, which does not add risk and won't cap our upside. All right, so here's our position. 100 shares of Home Depot at 35.62. We bought the August 39 put for 480. All right, so my total cost in the position, or my break even at expiration, is 40.42. Okay, it's right there shown with the magenta line here, $40.42. I bought the stock at 35.62. It's now at 37.22. We're guaranteed an exit of $39, so the most we're risking is $1.42 per share, okay, or 3.5%. Now, with the stock at 37.22, I might consider, let's take a look at the options, okay? Let's go up to the top and take a look at the View Options menu. And I'm going to focus on April because I think March is a little bit too close. So let's focus on April, 43 days out in time, all right? Perfect. I was hoping this had single strikes, and it does. All right. So with the stock at 37.22, I might consider selling a 38 call. Remember, in income method number 6, I can sell a call below the put strike price. I would never do that with just income method number 1. But with income method number 6, we can do that. So I might consider selling the 38 call for 66 cents. And at the same time, I'm going to buy the 40 call for about 19 cents. Let's just call it 20 cents. So my net credit is going to be 46 cents into the position. We're going to simulate selling to open the 38 call at 66 cents, buying to open the 40 call at 22 cents. Now, normally, let me do something very quickly here. Normally, what that would do, give me 1 second. I apologize for this, but just give me 1 second. Normally what that would do, I'm going to go back into the custom spread builder. We're just going to build that quick spread. And I apologize. That was on our HD position, Home Depot, right? Okay. Now what did I say? We were going to sell our April 38 call for 66 cents. We're going to buy a 40 call for 20 cents. I'm simulating just to keep the numbers a little bit easier off the fly here. I'm going to sell 38. We're just going to do one contract, okay, for 0.66. At the same time, I'm going to buy that April 40 call for 20 cents. Now just by itself, just the bear call spread by itself, we know what that would look like. Or this is what it would look like. Collected a 46-cent premium, and our maximum risk is the difference in strike prices, 2 points, 38 and 40, minus the net credit. So $2 minus 46 cents net credit would be $1.54, 154 per one contract. So this is what we're doing with the bear call spread. If the stock goes above 40, we would lose that full $1.54. If the stock stays below 38, we'll make the maximum profit of 46 cents. This is the bear call credit spread by itself. Because what happens when the stock moves up above 40? What happens when the stock's trading at $42 per share on April expiration? Well, I sold a call at 38, which obligates me to deliver shares of stock I don't own. But I bought a call at 40, so I reserve the right to buy shares of stock at 40. So even if the stock went up to 50, I'm going to buy shares of stock at 40, sell them at 38, take a $2 loss, but I keep the 46 cents, so I'm losing $154. Now, why is this advocated in the married put technique if it's a bullish strategy? Well, because in the situation where we sell this call and buy this call and still generate the credit of 46 cents, we also own the stock as the underlying. So as the stock continues to move up, sure, we have the $2 loss between the strike prices if the stock was trading at 42, 43, or 44, but we have a stock that's gaining one-to-one delta. So as we lose $2 here, if the stock was trading right at 40, we've also gained $2 by owning the stock. And if it went to 42, we'd have gained $4 from $38 and so forth. Well, let's go back to what we had with the married put position that we saw from our position analysis screen. And let's go ahead now. Remember, this was our married put. Let's add that same bear call spread to our married put position. So I'm going to sell a 38 call at 66 cents again, and we're going to buy the 40 at 20 cents. So when I click Added, puts it into my screen. Sell one, buy one. Natural bid of 66, and we're putting in an ask price of 20 cents there for our buy call at 40. All right, now let's go ahead and submit that and take a look. Now, what happens? We have stock that gains one-to-one as the stock continues to move up in price. We've sold a call at 38, which obligates us to deliver shares of stock at 38. Now, normally what you'd want to focus on is the red line here, the curved line at the halfway point. But let's just look at the blue line here, which is just showing us the profit and loss at April expiration. Assuming we just let the stock do what it wants, we make no adjustments between now and April expiration on this income method. All right? And of course, keep in mind, we still have a far out in time August put option, which is retaining a lot of its time premium. It's losing intrinsic value as the stock moves up above the strike price, but at the same time, we're not really losing a lot of the time premium that we paid into the position. All right. So on April expiration, if the stock was trading right at $38, what would happen? Well, the 38 call would still expire worthless. Our 40 call that we bought would expire worthless. We'd lose the 20 cents we paid into it. We'd keep the 60 cents that we sold the original 38 call for. We still have the stock. So let's just simulate that. Stock trading at $38. Let me see right here what our gain would be. Of course, it would be roughly $81 would be our total profit on the position. We've lowered our cost basis to now $39.96 based on the 46 cents of premium. The most we can lose on the downside, remember, is only 2.5% now. We've lowered that from the original married put position. Even if the stock takes off, right here at 40, we're only losing $13, so it's still well below the maximum risk. Even though it drops a little bit as the stock moves up here, we're still not losing anything. We're only losing a little bit. All right, so what would happen if the stock was trading at $38 on April 16th, the Friday of expiration? Well, you bought stock at $35.62, and it'd be worth $3,800, so you'd have a gain of $238 on the stock. Theoretically, the put would be trading at $2.77, so we'd have a loss of $203 on the position. We'd keep the 66-cent premium we received for selling the April 38 call, and of course, our long call, our 40 strike call would expire with this, so we'd lose 20 cents. So there's the total expected profit of $81 if the stock's trading right at 38 on April expiration. Now, why do we have this drop? Why does it start to fall off in price? Well, remember the magic at expiration. We sold an April call, we bought an April call. At April expiration, both of those deltas are going to go to 1 or 0. So the problem here by selling this 38, when we sold this 38 call, what happens is if the stock moves up to 39, what's going to happen? Well, we gained another dollar on the stock because it's now trading at 39, but it would cost us $1 to either buy to close the 39 call, so we didn't get that on the stock. We lost that on the stock. This short call is countering the gain on the stock at this point, but I'm sorry, we'd either have to deliver our shares of stock and our 40 call would still expire worthless, and our put is still declining a little bit in price, so we're falling off the maximum profit. Now what happens if the stock's trading at 40? Well, our short call would be $2 in the money. It would cost us $2 to close it, or we would just deliver the shares of stock, and we wouldn't take advantage of the gain up to 40. Our 40 call would still expire worthless, and the put would be declining in value. Now, what happens after $40? What happens at 41? Oh, well, stock's now at 41. Essentially, from this point, from $38, we've gained $3 on the stock. In a sense, we're down $3 on the 38 strike put as well, but we gained another $1 now because the long call is in the money. And instead of having a delta of 0, as it did when the stock was trading at 39 or 38 or at 40, our long call went to a delta of 1 magically at expiration because it's in the money now. Both options have a delta of 1. So we gained $3 on the stock technically from 38. From where we were at $38, I'm sorry, we gained $3 on the stock. We technically lost $3 on the call because we capped our gain, or we'd have to pay $3 intrinsic value to close our short call obligation, but now we've gained $1 on the long call. What would happen at 42? We would just keep going up now. Because again, if we're at 42, it's a terrible straight line, I apologize for that, but you kind of get the idea here. But this continues to go up at this price. Why? Because now that we're at 42, gained $4 on the stock, technically lost $4 on my short call obligation, but I've gained $2 back from my long call because it's now $2 in the money. And that would continue as we continue to go up. We haven't capped our gain because this $2 loss, the difference in strike prices, since we own the stock, that's handled by the long stock ownership. So really, the stock continues to grow, and we can't lose any more than this 2-point difference, which when we own stock with having a bear call credit spread, that's countered because we did have the $2 gain in the stock from where we were. I don't know if that helped you, Shook, but that's the best explanation I can give here as to how income method number 6 works as the stock continues to move up. We did sell a call that obligates us to deliver shares of stock at 38, but as the stock continues to move up, our long call and our stock ownership, one of the two, is going to counter what we're obligated to deliver our shares of stock in. And of course, as the stock moves up, the put's going to continue to decline in value also. It's going to get closer and closer to 0 as we go up to $45, $50 per share. But we still have the unlimited upside because after this $2 point, this long call is countering the loss, any further loss we have from the short call, and the long stock is continuing to grow. We have 4 instruments working in one conjunction. Oh, this here? See, remember, on the upside, our max profit is still infinite. Let me go back and clear this out very quickly. What was our original maximum risk when we opened the position? It was $1.42. Here's the original married put show. Our cost basis was $40.42 a share, and we had the 39 put. So we have a maximum risk of $1.42. That's on the downside, right? Down here at the bottom, if the stock tanked, went to $2 per share, we'd probably have a loss of 3.5%. Now, what are we going to do with income method number 6? We're generating premium. Right? So we have a risk of $1.42 on the downside. It's the most we can lose on the married put. I sell a call for 66 cents. I buy a call for 20 cents. We put in 20 cents, remember. So 0.66 and 0.20. So what does that do? That generates 46 cents of net credit. Now essentially I think we might be looking at a rounding error here, because what it's saying now is that we paid $35.62, we paid $4.80 for the put, so that was the original position we saw. We had the $1.42 at risk. Now we generated 46 cents of net credit against that. So we've dropped our cost basis down to $39.96. The total invested into the position is $39.96, but we're guaranteed an exit of $39. So that $99 risk would happen. What happens if the stock goes to zero on April expiration? It's talking about the downside risk. That's the most we can lose on the downside. We haven't bulletproofed the position yet. I can still lose if the stock goes all the way down to $0 per share. I still have a risk here at the bottom. As this continues down, it'll start to just level out. So we still have downside risk. I didn't bulletproof this position. So there you see, if the stock dropped to zero on April 16th, well, it can't divide by zero, unfortunately, so we have an expected value of about 1 cent we put in on the stock. 100 shares, 1 cent, be $1. So we've essentially lost the $35.62 on the stock. Our put would be worth about we'd have a gain on the put of $3,416. Hey, our short call would expire worthless, so we'd keep the $66 and we'd lose the $20 as well. So that would be our $99 loss. It's on the downside if the stock collapses. I haven't bulletproofed the position. If I put on income method number 6, remember our maximum risk was $1.42. If my premiums for selling this call, let's say this was, it's $1.42. I'm going to have to use math now. All right, let's say I collected $2 for the short call, and at the same time I only paid 58 cents for the long call. Oh, don't be $58. 58 cents, there we go. I would collect $1.42 of net credit. Okay, so this is a little bit of a rounding difference here, but what happens is my total cost basis is $3,900. Total requirement, maximum risk, this $3, I'm sorry, where that's coming from, Shook, that $3 risk is based on actually the commission fee I put in for one of those two legs. That's where the $3 is coming from. I apologize. That's what might be throwing you off. But yeah, see, so in this case, if I did generate the $1.42, if I put in this income method number 6, which I'm not close to getting, but if I got that, my risk now is essentially zero. Okay? Because now if the stock drops, I can't lose anything, and we still have unlimited upside. The max risk is based on what your original RPM was minus the new net credit. You lowered your risk. We dropped it from $1.42 down to about 99. Should have been, of course, 96, but I'm calculating in a $3 commission fee when I first entered that RPM on Home Depot as paper trade. Okay, and Chuck, you know, if you have any further questions about it, just feel free to send me an email and let me know. I might not have had the exact numbers you were looking for, so it might have been a little bit difficult, I understand, for you to look at a new position from scratch and try to figure out, okay, where were we at the first place, and then if you did the sell call, buy call, where would you be, and so forth. But yeah, no, just let me know if you have any other questions about it, or if you have questions for Kurt about his specific NTAP position that he had that he closed in Fission, for example. All right, well, a little bit beyond, but that's always okay. Let's go ahead and wrap up for the evening. Again, if you think of any questions later on, go ahead and give us a call during market hours at 877, toll free if you live inside the continental U.S., during market hours at 877-992-7971. If you live outside the continental U.S., go ahead and you can reach us at 302-992-7971. Of course, you can always email us at any time to support@powerop.com. And someone remind me to change the font, that link color that keeps coming up when I put that email address in there, because I know it's very hard to see. But the email is to support@powerop.com. And you just send me an email anytime and let me know. All right, Chuck, you have a great weekend as well. Thank you for joining us. I hope that explanation worked for you. And Mark, as Kurt says, you're the best, Mike. Thanks, Mark. I appreciate that as well. Ladies and gentlemen, thank you for joining me for our Friday open discussion session. I apologize, but we won't be here next week. I'll be traveling, but 2 weeks from now on the 11th, 2 weeks from now on the 18th, we'll be back for a Friday afternoon open discussion presentation. Take care, everyone. Have a great weekend. We hope to see you soon for our upcoming live webinars. Good night.